One of the biggest lessons I learned was very early on in my career as an independent trader, and I'm sure it's a situation that a lot of us have experienced. I developed a bias for the Dow Jones where I thought the market was going to go up. The market had moved into an area of support that I had identified, so I went long. But the market didn't agree with me. It went through that support level and stopped me out. Fast forward about another hour, hour and a half, and I'd entered 4 or 5 other trades, all in the same direction, and all ending up in losses as well. And I couldn't tell you exactly how I felt during those first 4 or 5 trades because my emotions had taken over. I wasn't thinking rationally. I just was not doing the things that was according to my trade plan. About the fifth, sixth trade in, I came to my senses and I realized that I felt physically sick and ashamed that I had deviated away from my trade plan and I was doing some really bad damage to my account. I was compounding losses, I was increasing leverage, and I was actually ending up doing some severe damage to my account. And I remember at that moment thinking to myself, I'm not going to make it as a trader if I continue trading like this. And I therefore then came to the decision that once that trade finished, I was going to walk away from the screen and work out what I had done wrong. Now that trade ended up winning, and unfortunately this is the case for a lot of people who then don't actually learn their lesson from that situation. They are back to break even and they think that actually that justifies their response. A winning trade is not necessarily a good trade and not good trading, and a losing trade is not necessarily bad trade and bad trading. We have to follow the process. We have to have a set of strong risk principles in place and then follow that process, and that is what's going to make us a successful trader in the long term.